Hello, welcome back. So today we are going to study about the next classification is valuation of liabilities. So how the liabilities will be valued and verified by an auditor we will be studying today. The liabilities we are going to study here is creditors, outstanding expenses, bills payable and contingent liability. So the first one is creditors. So who is called as creditor? The person or a company to whom the money is owing. So in case if a person borrows or if a business borrows loan from the bank of rupees 1 lakh. So the person who is borrowing is called as a creditor. That means who is liable to pay the money to the bank along with the principal plus interest. That's an example. So in case if the business has a creditor, so how the auditor should examine, we'll be studying now. The first one, the auditor should obtain the confirmation statement from the creditors. So you need to obtain, so how many number of creditors are there, how much of amount is pending, how much of money yet to be returned by the creditor, and should compare this with the statement of creditors as sent by the company. So the company will be sending the statement of creditors. Who are all the creditors? That amount should be payable. Amount should be payable to the business, and that should be verified. That should be confirmed with the statement of the creditors by the company which has been sent to the auditor. So after the statement verification, you should verify the purchase ledger, invoice, etc. So you need to examine when the purchase has been made with the help of purchase ledger and what is the invoice. So invoice is a receipt or the proof for the purpose of purchasing the product or sale of the product. So you need to examine. So once the verification of purchase ledger has been made, it is advisable to have a test check of all purchases made during the year. So along with the purchase ledger verification, so you need to examine, you need to have the test of all purchases made during the year. So whatever the purchases has been made, and in that purchases, so how many members have been paid fully or how many is not paid fully, it is creditors, you need to examine. So this is regarding with the creditors. Now we'll go for the next one is outstanding expenses. What is the meaning of outstanding? The balance yet to be paid. That is not yet paid. It's a balance available, balance. So in case of outstanding expenses, so how the auditor should examine? The auditor should obtain the statement of all outstanding expenses signed by the responsible official. There will be the specific official. So who is the in charge for maintaining the outstanding expenses statement? So this statement gives detailed information about how much amount is not yet paid. It is due. Then it has to be verified. So obtain the statement of all outstanding expenses signed by the responsible officer. So once the statement has been taken by an auditor, so you should see whether these expenses have been properly disclosed or not. So along with the statement, you need to check, you need to see whether these outstanding expenses have been properly disclosed according to the accounting format or not. So once the disclosed information is true, then you should ascertain the accuracy of the accounting records. Sometimes there is a possibility of giving the false records, false statement. So the auditor should be very careful whether the statement given it is true or fair, or it is fake or true. So you need to ascertain the accuracy, the trueness of the accounting records, whether they are prepared, the statement given it is true or false, it is right or wrong. In case if you find the statement is not up to the mark or the statement is incomplete, the statement is having any error or fraud, then the auditor may raise the queries to the responsible official. Next, bills payable. So what is bills payable? Bills payable is a document which shows the amount owed by the goods or services received on credit. So in case if the goods has been purchased on the basis of credit, so then at the time at that situation it is called as bills payable. It's a document or it's an invoice, it's a proof which shows the amount owed for goods or services received on credit. The goods will be sent, the amount will be paid in the further date as per the understanding agreement made. So when the bills payable arises, how the auditor should examine. Bills payable or negotiable instruments acknowledging the debt. So it's a negotiable instrument means which can be transferred from one person to another person. So once the bills payable has been raised, so you should get the statement of bills payable. So you need to get a list or statement of bills payable and you need to compare it with the bills payable book. So bills payable book, which is a book which gives the information, detailed information on the goods which has been given and the amount yet to be received from the purchaser. So you need to examine the statement of bills payable with the bills payable book. Once the verification has been done with the statement of bills and bills payable, so in case if any bills payable have been paid after balance sheet but before the audit, you should verify cash book and passbook. So in case if any bills payable has been paid after the balance sheet date, so once the balance sheet is completed, so after the completion of balance sheet or preparation of balance sheet date, so but before the audit, so before the audit takes place, so you should verify the cash book and passbook. Such bills should not be included in the balance sheet because the accounting year says that is from the 1st of April to 21st of March. In case if the bills payable has been paid after the closing of the account, so the auditor should verify the cash book and passbook. You need to verify how much of cash has been received and what is the bank statement along with the statement of bills payable. So such things, such payments should not be included in the balance sheet because the year ending is only from 1st of April to 21st of March. So whatever transaction has been occurred in that particular year, it has to be taken in the particular year only, not the next year. So next we'll go for contingent liability. So what is contingent liability and how it is verified? So it is the future uncertainty liability which is depend on the happening of some event is called as contingent liability. So this type of liabilities, so it may or may not arise in future. So sometimes what happens, so the business would have given the loan, so they may get, they may not get. So as example says, when the bills receivable discounted claims against the company, etc. So the auditor should see whether all contingent liabilities are disclosed in the balance sheet. So it's a contingent liabilities here. The future uncertainty. Uncertainty means what? We don't know what will happen. Whether we may get the amount or we may not get the amount which has been given by us. So which is dependent on the happening of someone's event. So in case once for example, if the person has taken loan from the bank, so he may return the money with the principal or the interest, or he may not return the money with the principal or the interest. So in case if it is returned, it is well and good. If it does not return, then it is called as a contingent liability. So it may or may not arise in the future. They may get or they may not get. So example, the bills receivable discounted claims against the company, etc. So these like this, the auditor should see whether all the contingent liabilities are disclosed in the balance sheet. In case if it is any contingent liability, it has to be shown in the balance sheet and you need to verify. Thank you.